Good morning and welcome to our March editions of Economics Watch. I'm still Gad Lebanon. I look a little different. I had a devastating haircut, but otherwise I'm the same person, and I'm Chief Economist North America here at the Conference Board. And welcome to our webcast. Today we are going to focus on the US labor market in our second part of our webcast. Some of the main questions that we'll deal with: can the fast global expansion continue as we see more market volatility? There have been significant government moves, the federal spending and the tax cuts and the new tariffs. What does that mean for the US economy for the next 2 years? Relates to the labor market, how the challenging demographic outlook is going to impact companies in terms of labor shortages, and what solutions should businesses consider to deal with that talent squeeze. So we're going to talk about all this and more. For those of you who are interested in credit, in CPE credit, type your full name and email address in the space provided, and there will be 3 OK pop-ups. You need to click on them during the program. You should stay for the entire webcast, and credit is available for live participation only. I wanted to give you more tips, but I'll give it to you without a slide. The webcast tips. First of all, if you have questions, don't hesitate to type them on the chat box at the bottom left of your screen, and we'll take them as they come. Feel free to download the presentation via the file download pod at the bottom center of your screen. You may full screen the video or the PowerPoint at any time by clicking the 4 arrows at the top right of your screen. If you have a minute at the end of our presentation, please complete a brief evaluation so we can implement your feedback in future programs. And finally, if you want to watch this webcast again or share it with colleagues, it will be available on demand on the Conference Board website. Now, before we officially start, let me present the other participants in this webcast. First of all, in the middle, the guy without the tie, Ataman Ozildarin, Director of Business Cycles and Growth Research, who's a regular on this webcast. Welcome, Ataman.
Good morning, Gad. Good to be here.
On the far left, also a regular, is Brian Shaitkin, Senior Economist. Welcome, Brian.
Thank you, Gad. Happy to rank second in total hair on my head on this webcast panel.
And finally, the person with the most hair, Frank Steamers, Associate Economist, and beginning to be a regular on our webcast. Welcome, Frank.
Thank you, Gad.
So, we'll start as usual with the global economy. So, Ataman, what are some of the main trends we are seeing there?
Okay. So we're seeing kind of the continuation of the strengthening growth trend in 2018. We've been kind of seeing that growth has been coming in better than expected, and there's a synchronized growth outlook around the world. So both mature economies and emerging economies. Although we might see the mature economies kind of pull back a little bit, and then the emerging markets regain, as you'll see in our updated projections. But the strong momentum is really continuing from the second half of 2017. Growth will probably end up around 3.2% globally, and that's higher than our initial projection a year ago, which was 2.8%. That was a little bit of a surprise on the upside. And it's a continuation of sort of the solidifying recovery in the business cycle and the positive sort of virtuous cycle continuing that gave us the expectation of better growth, and then we saw that kind of becoming more robust as we entered 2018. So the current projection for 2018 rests at about 3.3%, but we do see some significant upside potential. And I think As Brian will also discuss, most of that potential comes from the US economy. And the usual saying goes that the US economy leads the world. So I think that's still to some extent true. Even if not as much as maybe a decade ago, we still see the US economy as an engine of growth. And then the emerging markets will kind of regain their ascendancy as well going forward. The European growth projections have been better than expected, and we expect strong numbers in the fourth quarter. The sort of conundrum there is that even though growth is improving, demand is improving, labor markets are really good, inflation remains stubbornly low. And at this stage of the recovery, we would start to see more inflation in Europe as well, but that may be coming as there are some lags in these processes. A topic that we're going to touch on a little bit today, both in the global view and the US view, is the observation that global trade has picked up since about the middle of 2016. That recovery came hand in hand with the global economic recovery. But the work that we've been undertaking over the last half year or so suggests that improvement in global trade is more likely to be cyclical, so it's not going to be sustained for the long term. And we'll touch on that a little bit. There are some reasons why we would expect that not to be sustained. But all in all, we do see this synchronized growth continuing in 2018. We see the recession risk fairly low in 2018. We get that question a lot, when is the next recession going to be? But if you look at the leading indicators so far, there's no significant imbalance that's happening in the business cycle to lead to a serious worry about recession risk. But at the same time, we're seeing the volatility returning. So it's we're going back to the old normal of more volatile stock markets, financial markets, at the same time as we have the better sort of growth outlook. Just a couple of charts to give you a taste of what the leading indicators are saying. And a lot of the reason why we see that synchronized growth is that we see leading indicators picking up across the world, and especially the US, Euro area, and China are driving that growth. And you see that here with the contributions to the global LEI that we're tracking over sort of 6 months periods leading up to the most recent data for the global LEI through December 2017. The contributions from those three economies have really been driving the leading indicators looking ahead. So this is our usual global projections chart for selected economies and regions. And of course, in our global economic outlook, we now cover 69 economies, and we can't put all of them here, but these are sort of the most important economies, and then dividing them as mature and emerging markets. And generally, the mature economies are doing well. The most significant uptick is coming from the US, and that has to do with the fundamentals of the economic expansion, as well as the improving positive outlook, the expectations kind of starting to be playing out in terms of not just the consumer side, but also business spending picking up there too. So that's kind of a leading indicator for the whole economy. And overall, the emerging economies are also picking up, whether you look at the emerging Asia, especially India, where we see a pickup. Latin America and Sub-Saharan Africa are all showing an improved outlook for 2018. So there's a lot to say for the glass half full outlook story, but that seems to be more of a short-term story. And for the medium term, we still kind of look at a moderating outlook where both from the demand and the supply side, there are constraints holding down that longer-term growth rates.
Yeah, I would just, one thing I would add, it's interesting that in this chart, there is no negative numbers, which I think is, if we go back several years, there's always an area in the globe that is in a recession or suffering from negative growth, and we are now, I would say, probably outside of Venezuela and maybe a few other countries, everyone is growing. So that helps the synchronized growth.
Right. That's an important point because the growth is widespread, except for a few pockets that seem to be isolated and what the economists call idiosyncratic. They're random, sort of very unique to the local conditions, like Venezuela. And if you are looking for a negative in this chart, it's not easy to see, but we did kind of pull back the growth outlook for the United Kingdom. The leading indicators have been signaling weakness there, and if you look at that, the UK is probably the closest to a recession signal, and Brexit developments will actually worsen that outlook for the UK too. So that's kind of the alarm bell that's ringing in Europe. And of course, there's still a lot of interaction between the UK and the euro area, even though the euro area is kind of maintaining that growth momentum. So overall, the world economy is resting comfortably in the 3 and 3.5% growth range, and that's a slight improvement over the previous year. Now, I mentioned global trade, and we did observe that since about the middle of 2016, growth in global trade has picked up, and that's noteworthy because for a long time, the global growth trade remained below global GDP growth rates, and that's unusual compared to the past, where you see the past here, pre-global recession in 2018. Global trade often grew much faster than global GDP. Of course, we had the great contraction and then a big recovery after that, but the recovery in trade did not maintain above global GDP. So we've been looking into what are the reasons behind that. And we have a report that just came out, and there's another one in the works that's looking at sort of the labor market implications of slower global trade, which is kind of a sign of major changes that are happening in the global value chains. So the first report looks at those global value chains. And I believe next month you're going to talk more about that with our co-authors on that report. So we interpret this pickup in the global trade that we see recently as a cyclical pickup that's helped by the improvement in global GDP growth. And that's good news, but we don't expect that to rise much past the level now, or to be very sustained. But in the short term, that's very good news for exports and imports, and that increases sort of economic dynamics and is also supported by that synchronized growth that we were seeing. I should also probably mention, if you allow me another plug-in for another webcast, upcoming actually on March 28th, there is a special window on webcast which will look at trade policy issues. And we have a couple of great guests on that, moderated by our chief economist. So if you're interested in the trade policy issues, especially the recent announcement of the steel and aluminum tariffs and how that might unfold, I would recommend looking at that webcast as well. So this looks like a topic that will be with us for a while, and you'll be, I think, hearing more about that.
Brian, you're going to be on that webcast, right?
Yes. No, actually, no. But one of Ottoman's co-authors, Ilaria Miceli, our European economist, will be on the Window on America webcast.
Right. So 2 webcasts, Window on America, March 28th, and then the usual Economics Watch webcast will also cover the trade issues and global value chains next month in April. So in this environment, the global financial markets, especially stock markets, were maybe uncharacteristically smooth in 2017. But that, of course, went away with the recent volatility in stock markets. And that wasn't just unique to the US stock markets, which is shown here by the S&P 500 index, the big drop in February. It has recovered from that recent sort of perhaps a correction, but it was a very large correction. And that translated around the world as well. So you saw global financial markets kind of reassessing risk and valuations, and you saw the similar drops in the global financial markets, stock markets. We interpreted that as somewhat as a positive signal where stock markets are kind of revaluing and kind of bringing down those expected valuations and reassessing the risk, given that the economic fundamentals and the growth rates were so strong. So, and we see some of that recovery regaining the value lost, but it's more than likely that 2018 will continue as a volatile year, especially in these financial markets, as kind of we move into a more sort of normalized growth environment going forward. So that also has implications for the U.S. And maybe it's a good time to kind of look at the U.S. Economy as it interacts with the global.
Yeah, that's a good point. And I think we're going to start with a polling question, if I understand correctly. So the studio, are you putting... yeah. So the first polling question that we have, because we also want to hear from you today, which of these factors is having the most influence on your business strategy? Current strength of domestic and global economy, tax cuts, rising interest rate, tightening labor market, and risk of labor shortages. So again, current strategy, current strength of domestic and global economy, tax cut, rising interest rates, and tightening labor market and risks of labor shortages. I'll give you a couple of more seconds. 5, 4, 3, 2, 1. And let's log the survey. So you're clearly not concerned about rising interest rates. Our audience, none of you chose that. A little over half chose labor shortages, and the other half went to the strength of the domestic and global economy and the tax cuts. I'm personally happy to see those results because most of our research in my group is about the labor shortages, so I'm happy other people are concerned.
But I think that shows the sensitivity to the important key areas in the economy, because that has both kind of that short-term impact through the wages and labor costs, and the secondary kind of impact on interest rates as well would be coming out from that. But also that's part of the longer-term supply constraints that we're talking about, right? Yeah. Because the quantity of labor is shrinking. And one thing I didn't mention is that we are also getting some good news from the productivity side, but it won't be enough to kind of offset the supply constraints that's marked by this.
Right.
And one of the reasons why I wanted to ask that question, getting into the U.S. forecast, was that we are seeing a weaker first quarter than was initially expected. We had anticipated that first quarter GDP last month would be about 3.3%. Due to weaker than expected retail sales and investment numbers, we're seeing 2.6%. But I think when businesses are thinking about their long-term strategy and the long-term objectives, it's not just a matter of that 1 quarter of data or even 1 year of data. It's about what are those challenges that are going to be with your business for the next decade or so. And I think Gad and Frank's report that they're going to talk about later really illustrates how labor shortages are one of those challenges. And so I think that's why it's so important to sort of have that longer term perspective. Now, why is it that we've seen that to start the year, GDP has come in somewhat weaker than initially expected? Well, first of all, there's been a fall off in terms of retail sales in general. February data that just came out this morning confirmed that fact. That's been led to some extent by durable goods. We've seen pent-up demand for cars and other big ticket items fall off over the last few months. And we've also noticed over the last few years that even though all consumption data are seasonally adjusted, there's a tendency for weaker than expected growth to occur in the first quarter. So I wouldn't read too much into what may ultimately be a weaker than expected first quarter GDP picture, especially because business and consumer confidence indicators are still quite strong. That's an indication that under the right circumstances, consumers are ready to spend more, businesses are ready to invest more. Certainly the incentives from the tax cuts will play into that. Job creation, we're also seeing, even at this later stage of the cycle, business cycle, even with tighter labor markets, more than 300,000 jobs were created this month. There's certainly no slowing in the pace of job creation, even on a 12-month basis. And so that means tighter labor markets, eventually lower unemployment rates, and supply and demand conditions suggest that that should eventually lead to another acceleration in terms of wages. In addition
Can I just, you mentioned that today was the retail sales report?
Yes.
So what was the outcome?
It was somewhat weaker than would have been expected.
For February?
Yes, for February. And January data were also weaker. Again, so far, we've seen over the last few years that data for retail, for consumption, especially in Q1, tends to be somewhat weaker than one might expect. In addition to that, another factor driving demand is this new federal spending that's coming out as a result of the bipartisan budget deal. We'll talk a little bit more about that, but that's another factor that's going to increase the demand for labor and is going to result in somewhat tighter labor markets. And the result is that the Federal Reserve will likely interpret that to mean that interest rates may rise more quickly. That could drive up corporate and mortgage rates, reducing investment and housing construction during the next year. And in addition, another major risk is the change in policy regarding trade coming out of the U.S. administration. This month, new steel and aluminum tariffs were announced. Originally, they were intended to apply to all countries sending steel and aluminum into the U.S. Thus far, it appears that Australia and the two NAFTA countries, Canada and Mexico, will be exempted from those tariffs, at least as long as NAFTA negotiations continue. That's going to lead to somewhat more job creation in steel producing industries, but the much larger steel consuming industries, such as the auto sector, you're likely to see less employment as a result. And what that's going to mean ultimately is probably net fewer jobs. It's also important to remember that EU countries and other trading partners are likely to enact retaliatory tariffs. Those will be targeted on important US government officials, and that's sort of how those tariffs will be designed. That can result in additional supply chain disruption and additional risk to jobs. And I think the larger story is that right now, the U.S. Trade Representative's Office is continuing a Section 301 investigation into China. That's an evaluation of how U.S. tech firms and intellectual property is being treated there. And that could potentially result in a much wider trade war. And as Ottoman mentioned, the one country that is currently not participating in this global synchronization to the same extent is the UK. It did enact, by exiting the European Union, less connection with the global trading system. And so there's a risk that, depending on how this new trade policy plays out, that the US may end up in a similar situation. We'll have much more detail on sort of how to think about these trade restrictions and also sort of the larger question of global value chains on the next edition of Economic Swaps. Let me go through a few elements of the underlying forecast. So this chart shows that consumer confidence, the blue line, remains strong. We're seeing that disappointing first quarter consumption data led by durable goods. We do expect that to pick up over the next quarter. So I think over the next few quarters into 2018, and for even though first quarter consumption may be weaker than expected, you're going to see stronger consumption overall going forward. Turning to employment, what this chart is showing is that very impressive February 2017 job gain, along with the 3, 6, and 12-month average growth rates in terms of employment, showing very little signs of slowdown, at least since 2016. You saw some higher levels back in 2015, but still this is remarkably strong job creation levels given this late stage of the expansion. A lot of it is the result of actually new participation in the labor market, and that's why you're seeing that the blue line in this chart, the unemployment rate, has not declined since September. It's still very low at 4.1%, the lowest we've seen in almost 2 decades. But the fact that you're having more men, more women enter the labor market who were sitting on the sidelines, that's allowing the unemployment rate to stay stable. That's also part of the reason why these two wage growth measures haven't picked up as quickly as they might have otherwise, just because there are new people coming into the labor market. But that's not something that can continue forever. So we would anticipate that as this expansion continues, there will be more upward pressure on wages, and Gad and Frank will have some more details on why we think that's the case during the second half of this program.
Let me maybe just mention here that in recent weeks, there is a growing, I would say, attention of the academic community to the idea of wage suppression by non-compete clauses, which is very prevalent in the entire economy. And just it happens that in recent weeks there are a bunch of new papers on that, which is fueling some legislation or supporting some legislation and supervision on that topic, because some of those papers are arguing that wages are significantly lower than they would have been if there was no kind of non-compete clauses and non-poaching agreement between companies. So I expect that this will create some backlash, perhaps, and more attention to the topic in the future.
And I think this story of structural change overall in the labor market and sort of how it translates into how supply and demand conditions shape wages is a very important one. Another stream of research is happening right now in terms of industry concentration in local labor markets and wage growth. So there's a lot to talk about on these structural factors, and it's definitely something that merits more discussion as we go on. But just to give you a few more pieces of the outlook before we turn to the labor market section. Investment momentum did slow in the first quarter. I show here growth of non-defense capital goods new orders, or new shipments rather, which did slow down a little bit in the last few months. We do expect that as firms sort of adjust to the new tax law, they will increase their investment, especially in capital equipment, but there's no special incentive under the law to invest immediately. So as a result of that, it's not necessarily the case that even though manufacturing confidence, which is represented by the red line, remains quite high, there's no reason why you would need that investment to pick up during the first quarter. So I don't see it as a sign that the tax cuts won't have their intended effect yet. We'll have to watch how investment behavior evolves over the next few quarters before we'll be able to draw a clearer conclusion on that. And then,
go ahead, sorry.
And then finally, turning to this bipartisan budget bill, what has come out is about $300 billion in new spending authority that's going to be authorized over 2018 and 2019. Now that's going to actually be spent over the next few years. And the bulk of that spending is likely to happen in 2019 just because the package was announced just last month. So it's going to take some time to get those new spending programs both in there. It's evenly divided between defense and non-defense, a lot of healthcare, a lot of disaster relief there. So we expect it to have more of an impact on our 2019 relative to 2018 forecast. We did revise our 2019 GDP from 2.6 to 3.0. But there is the risk that all of that spending is going to require more workers to implement that. That's going to create more pressure on the labor market, more tightness, and the result of that is going to be that the Federal Reserve is likely to act to curb interest rate increases, and therefore there's a risk that those corporate interest rates, mortgage interest rates could rise, dissuading homeowners, dissuading firms from investment. We'll see how much of a factor higher interest rates end up playing, but we definitely have seen Treasury rates and those corporate and mortgage rates rising over time. And so I think we have to consider what is going to happen as the labor market tightens to the economy. How is that going to affect both firms and also consumers? And to talk more about sort of what we're seeing in terms of short-term and long-term labor market dynamics, I'll turn it over to Gad and Frank.
Well, there's one more slide that I'm sure you wanted to talk about, and our forecast.
Okay, so just very briefly, I did point out that we had raised our GDP forecast for 2019 up to 3% because of that bipartisan budget deal. So I think that's a key factor. And also, I mean, you can see here that non-residential investment was taken down due to, and also consumption numbers were taken down due to weak first quarter performance. But we expect that both of those by the end of the year will get up to quite high levels. Real consumer spending will finish near 3%. Non-residential investment will pick up off of strong 2017 numbers from 4.7 to 5.4. And then unemployment rates by the end of 2019 may well be below 3.5%. And that's a figure that we have not seen since World War II, and which is not just a function of a robust economic growth picture, but is the function of some longer term factors affecting not just the US, but other mature economies.
Thank you, Ryan. And I think so the biggest changes that we made to our forecast compared to last month are for the late 2018 and 2019 as a result of the new spending bill, right? So now if you look all the way to the right and the top, our annual forecast now for 2018 and 2019 is exactly 3%, which is well above the trend of the US economy. And as partly as a result, the unemployment rate going to levels that were not seen in a while, and that's a good segue to our topic of the global labor market outlook. I do believe that we have another polling question, or no, not yet.
No, that comes up a little later.
Yeah, a little later. Okay, so what we're going to talk about, as kind of was mentioned during the discussion so far, it is becoming, the labor market is getting tighter in many countries, but not in every country. So there are still areas, especially in Europe, countries like Spain and Greece and Italy and Portugal, actually Portugal not so much, where the unemployment rate are still elevated and tight labor markets are years away. But the overall trend is for tighter labor markets. It's becoming harder to recruit and retain workers. What we're going to talk about are some of the changes in the environment and what companies are doing or should be doing to deal with the difficulties of the labor shortages and the tightening labor market. Some of them related to location, to shifting operations to areas with more available workers, shifting jobs from office to teleworking or remote working, raising compensation. That, as we mentioned, something that is happening more slowly than one would expect. But we think that as we move forward, companies that will be slow to do that are going to suffer from more labor turnover and harder recruiting difficulties. We are seeing where we are seeing some wage growth more visible is in the United States, is in the blue collar occupations. We'll mention some of those. Now, and it's important to remember that it's not the damage from labor shortages is not a done deal. There is a lot that both companies and government can do about it, and we're going to mention some of those things today. So Frank, the kind of the core or the basic of everything that we're talking about related to labor shortages starts from demographics.
Yeah, exactly. So in the beginning of the webcast, Brian, Atem, and I have been talking about strong economic growth, putting extra pressure on the labor market. But at the Labor Market Center, we often like to start with a chart like this, in which we exactly look at the working age population, so the people that are actually available for the labor force. And this is something we have been emphasizing at the conference board, because we know the trend of aging, and this is going to play out in some countries already at the moment, and in the US it's going to play out in the next 10 to 15 years, and that is what we're showing here in this chart. So you're looking at the people exiting the labor force over the people entering the labor force, so that is the people 60 to 64 over the people 15 to 19, because that are the people that either exiting or entering the labor force in the next 5 years. So a ratio higher than 1 means that more people are exiting the working age population. So directly you see you have Russia, Japan, Eastern Europe, where it is already a problem. On the other hand, you have mostly emerging markets, developing economies, where it is not a problem at all. And it's interesting also to look at the US. You can see that the US is still doing okay. It is close. It's still having more people entering the labor market, and that has to do with that the US has always had a little bit more international migration. But we know that in the next 10, 15 years, it's like in Germany, it's also going to be a problem in the US. And this is, of course, the first chart. We just talked about the working age population, but there are, of course, also people that are on the sidelines. So that is why we often like to look at unemployment rate, and the unemployment rate that shows the people that are working or looking for work or wanting to work. This is probably a chart that you have seen pretty often. So we know that currently the unemployment rate in the US is a little bit lower than just before the financial crisis. In Europe, it looks a little bit different. We know that after the Great Recession, the euro area had the euro crisis, which put quite some countries further back. And to see these differences within the euro area, we can go to
I just remember this chart reminds me of the time around 2008, 2009, where Europeans were kind of feeling good that the unemployment rate in Europe was equal to that of the United States, but that didn't last for long. Yeah. No, sorry.
Right.
Yeah.
Okay. So if you go to the next slide. So here we want to show the differences between the current unemployment rate and the unemployment rate that we saw before the financial crisis. So we compare here 2017 unemployment rate to 2005 to 2007 unemployment. So you see Poland and Germany, they have a strong negative number, so that means that their current unemployment rate is much lower than it was before the financial crisis. So if we go to the bottom of the chart, you see Italy, you see Spain, you see Greece, and we know they were particularly hit in both Great Recession and in the Euro crisis, and for them it will probably still take years before they get back to a tight labor market. For the US audience, you see it's in the middle of the pack, but below Eastern Europe and below Germany, and this also comes back to the working age population chart. In Germany and Eastern Europe, the working age population has already started to decline, and that is much more an issue than for the US, at least in the next 5 years.
I think the Eastern European countries, they're kind of suffering from a double whammy. First of all, their demographics are naturally difficult because of the ratio of older people to younger people, and on top of that, they're suffering from a lot of migration from Eastern European countries to richer Western European countries, so that further tightens the labor market there, especially among high-skilled people.
Yeah, no, exactly. So just to continue to take a closer look at the US. So what we're looking here at is the participation rate of men and of women, because we now hear that the labor market is tight. We're also saying the labor market is tight, but what does that exactly mean? And the labor force participation rate is an indicator that we at the Conference Board often like to look at, because it can show us if there's still room in the labor market. So that means, are there still people returning to the labor market? For example, women, are they now encouraged to return? And in the last 2 to 3 years, we see actually a big uptick in young women entering the labor market. So that is something very positive. On the other hand, when we look at young men, because we're looking in this chart at the people aged 25 to 34, the participation rate is flat. So this is also a bit puzzling why it is not picking up. And there are theories about that, about Kruger, who has talked about the opiate crisis that is maybe keeping this participation rate lower. There are actually also seriously theories about gaming. You've mentioned that in the previous webcast. But for the US labor market, it will become very important to increase this participation rate to get more room in the labor market.
Right. And that is very much needed if we want to continue to grow. We mentioned the wages before. This is a kind of a part of the difficulty of getting a correct view or an accurate view of wage growth in the United States is that you have various measures, and each of them every year tells you a somewhat different story. So we put kind of the 4 main wage measures here, and we also adjusted that for inflation. So we see, I think, 2 main trends. One is that since 4, 5, 6 years ago, we're seeing a continuous acceleration, but a moderate acceleration. So even though we are almost 9 years since the end of the recession, we still have wage growth that are lower than the 2007 rate. We mentioned some of the reasons for that, and we'll talk more about it in the international context. But I think it's very interesting in the US to look at what we see in the blue-collar workers. So what we have here is from the employment cost index. We have the blue line is the year-over-year growth rate in wages for the private industry, all private industry workers. And then two of the largest blue-collar occupations, production workers and transportation and material moving workers, where there the acceleration, especially in the past 2 years, is much more visible, to the point that they are above their pre-recession rates. And we hear, especially in the transportation, there is a lot of anecdotal evidence. I think some of the reasons why we see that is a lot of baby boomers retiring, and young people don't want to become drivers, and that creates a shortage of people. On top of that, especially in transportation, a drug test is required, and a lot of people are either afraid to take a drug test or fail a drug test. So that is even further reducing the supply of workers there. So that's an area that, and if you think even further, when you think, if I want to be a driver, will I have a job 10 years from now? Maybe not if it's automated. So why would I want to go into this line of work to begin with? So it's really a triple whammy for the transportation workers, and a problem that until we have autonomous cars and trucks, drivers would be needed, and that is a serious issue.
And I think that's a key broader issue that many employers are going to face in terms of thinking about labor shortages. How do you deal with labor shortages in an occupation? Truck drivers are the perfect example of this, where on the one hand, there are profound current labor shortages, and for the next few years, a lot of cargo will continue to need to be moved by trucks. But 10 years down the line, it's not going to make sense to be trained in that occupation. There are many, many occupations in that same predicament. I think as we talk more about labor shortages, we have to think more about that question. How do you deal with sort of those near-term shortages that may eventually be addressed by technology, but for now will have to be addressed through human labor?
Yep, that's an excellent point. So now I knew that another poll question is coming, and it finally arrives. So let's see if the studio is going to put it on. Yeah. So our question for you now are, what strategy is your firm using to address labor shortages? Choose all that apply. So we have 4 options here: opening offices where there are more available workers, encouraging workers to delay retirement, increase use of remote working, increase use of contingent workers. Again, you can choose more than one, all that apply. So I see there is still movement there, so we'll give you a few more seconds, because you can make multiple choices here, so the complexity of the exercise is multiplied. So 5, 4, 3, 2, oh, there are still movements. I'll give you 3 more seconds. 3, 2, 1, 0. Good. Thank you. So interesting result. So each one got some votes. The most, the winner is the increased use of contingent workers, and the second is increased use of remote working. And far behind are opening offices where there are more available workers and encouraging workers to delay retirement. And very interesting. Any quick reactions from the panel?
So I think when we go back to the chart of Eastern Europe, and you see that profound labor shortages are beginning to grow there, and certainly there was the movement of less skill-intensive value chain stages to Eastern European countries. But at the same time, younger workers are voting with their feet. They're looking for locations where there's more potential for wage gain. And that's one of the challenges of thinking about this strategy of moving to locations where there are more available workers. Yes, local labor market conditions may be better in those locations for employers, but there's also structural reasons why those conditions are developing in that way. And so employers have to think critically about the nature of those locations and whether or not they're suitable for the work that they have in mind to be done in those locations.
So they need to find areas with low wages but with a future. Yeah.
Correct.
Yeah. Good. We have on each of those topics, or almost each of those topics, we have some slides that we'll elaborate on. So, what are some of the things that businesses can do or should be doing to address the tightening labor market? One is to increase the pool of workers they look for talent. We see that in some countries there is not the US, there is a very strong increase in the share of women participation in the labor force. Also, we see a trend more so in Europe than in the US of increasing participation of older workers. So those are kind of the most obvious ways to increase your workers pool. Increase compensation, that's of course always an option, but an option that companies are slow to choose. They prefer to use other avenues before they choose that, but eventually they don't have a choice. And we think that if they don't choose this, at some point they will experience higher labor turnover, which is already growing rapidly. We are also seeing some compromise in hiring. So we see that educational attainment of new workers is declining in recent years in the United States. More workers that are being hired, they either have just a high school diploma or even high school dropouts. And that's because a lot of the people with the higher degrees are already in the labor market, so companies have to go further down the educational attainment ladder. We had a blog about that that you can find on our website. We are seeing perhaps some signs of improvement in labor productivity. So tight labor market and more expensive workers necessitates automation, and we are seeing a bit of a pickup in labor productivity, and we're expecting more of that in the next decade. We are seeing a strong trend in the last decade of an increase in teleworking, and perhaps in the last year or two, this trend is accelerating as employers have both a tight labor market and advanced technologies of remote working, so that lends itself to solving the labor market tightness. And finally, contingent workers. Companies are likely to demand more contingent workers in order to cut their labor costs. The question, will they find a supply of labor that are willing to be contingent when labor market is stronger? That's one of the things that will be interesting to follow. So, Frank, in terms of expanding the pool of workers, there have been mixed trends among advanced economies.
Yeah, exactly. So in the previous slide, we already went further into the US, but now we have put the US trend into an international perspective, and we start in the late 80s and go to 2016. So first to understand, we're looking at the upper three lines, that is men participation, and as you can see, there is some difference, and that is that the US actually has had a decrease that we have not seen in most European countries and in Japan. And this is, of course, something about which we're also thinking, and this we discussed in the 2 slides ago, where I now want to focus on this women participation, because for women participation there's especially gains to be made. And again, you see the US that has been on a higher trend if you look at the late 80s, but it hasn't increased. And if you, for example, look at Japan, it is very interesting that in 2012 they made they saw how important it was, because in Japan it has an older population than the US, meaning that they serve as kind of an example. And you see a clear acceleration in women participation, very different than in the US, where we now have seen a small pickup in the last 2-3 years, and hopefully that is going to continue, but it is not as fast yet as we may have hoped. And in the EU 28, it has been increasing, and of course there are many differences among countries. We know that Sweden is always high, very high, is almost the same as men participation. On the other hand, we know that in Italy, for example, women participation is much lower than the European average. So that is women participation, and then other pool of untapped workers get mentioned already, older workers. And here we see again that since the Great Recession, actually in the US, it has stayed pretty flat and very different. Again, Japan, we see in 2012 a clear increase in the participation rate. Also Germany, mid-2000s, very interesting that it has a tremendous increase, and it keeps on increasing. In general, EU has been increasing. Of course, its trend has always been faster, but the levels has been below the US. And we see, of course, differences. Again, Italy is just below the trend, but still it has an increasing participation rate for all the workers. So that is good news for companies that may want to look into this pool of labor and see if they are actually hiring enough and looking enough in this.
Right.
This group.
And this chart was what I call the wow chart, when you see the increase here in Germany from a change of less than 15 years, from about 43% to about 70% participation rate in such a short time, is like, wow.
And there's a question about this chart from one of our viewers, which is that given that you've seen the US 55 to 64 participation rate not rise as quickly as some other countries, is the fact that Americans are saving less for retirement, is that going to result in an increase in terms of participation among these workers?
Right, so in the US, we've done some research on that exact question, and it is true that older workers in the United States are less prepared for retirement than they used to, and when that happens, they can do several things. They can work longer, they can, or two main things, work longer or spend less during retirement. We have seen a trend of increasing labor force participation of older workers for more than 20 years, but in the last 4 or 5 years, it kind of plateaued. So it could lead or start again. We have to remember that a lot of people really want to retire. They just don't want to work anymore, and it's hard to keep them in the labor force. We are almost running out of time, and I just wanted to, so I'm skipping here a few slides. Frank, if you can very briefly talk about teleworking, because it was one of the main things that was mentioned.
Mm-hmm. Yeah, so we have seen an increasing trend, of course, that businesses are now looking, okay, I don't need to hire any more people that are around my office. I can look further, and that is good for companies because it can increase their pool of labor. And with our new advanced remote working technologies, it seems to be very possible. So this is an increasing trend. In the last year, we actually saw a small acceleration. Mm-hmm. Of course, there's one data point, so we want to be careful with that, but it could indicate that with a tighter labor market, employers are shifting their attention.
Right. And the last slide I want to show you is and I don't have time to go into the details of that, but essentially what that shows you, that an increase in the share of contingent workers in manufacturing. We are going to have a report about contingent workers. This is in the small survey that we did earlier, the poll, it seems like the number one option, and we are indeed aware of it. We get a lot of questions about it, and we're planning to do more research on that in 2018. Just to, before we wrap up, just to mention that we are going to have the Economics Watch cycle, as we always do every month. Just remember that we'll be here again next month. in next months, we're going to talk a lot about trade, and will be Brian and I will be joined by Eric Land and Abdul Rumban, who just wrote a report on the trade issue. And there are, as always, more publications and webcasts that we keep doing on a regular basis. Some of them are here, and you're welcome to go to or click on those links or go to our webpage and find much more. So I want to thank our Brian, Ataman, Frank. Thank you for joining me today for an interesting and exciting conversation. And for members, if you have our audience, if you have a minute, we'll appreciate a quick feedback form to fill. Thank you very much to everyone who joined us today, and we hope to see you next month. Thank you. Bye.